one of the things where FNArena profiles itself is in reporting seasons, and we have two big ones. We have February and August, and then we have some companies reporting in between. But paying attention to company reports, of course, there's a very good reason for that, because the share market moves on different drivers, but ultimately it comes down to what companies obviously do for shareholders and the profits they report, the cash flows, and etc., the margins they have. And what came out of February is a big difference with what we saw last year. We had 2 times a disappointing reporting season last year. Twice a rally moving into reporting season, and twice the market came down and lost all the gains because company reports simply were not good enough. This year we had a similar situation, similar setup, big rally moving into February, and then it turned out company reports good enough. Now, I say good enough because good enough is not necessarily they were fantastic, they were good, but the situation has changed. At the macro level, we are looking forward towards hopefully a trough in economic momentum, although we are still going down, we're not sliding downhill here, but we are in particular looking forward to central bankers cutting interest rates. So we're going for lower bond yields and hopefully consumer spending holding up. That's the hope that's supporting the market. Within the context of low expectations, company reports were good enough to support where the market is and to not destroy the overall positive sentiment. That was the good thing that came out of the season. The big winner in February is technology, and that was very much feasible, very much sensible. Could be sensed on the local market. Big rises for some of the technology stocks. The results were absolutely mind-blowing in some occasions. It didn't get that much of traction in the general media for the simple reason that technology is supposedly a US phenomenon, and also that there are many more retailers and consumer-oriented companies listed on the ASX that were equally meeting or beating expectations, and all the attention went to discretionary retailers. But I think, and that is backed up by analysis done by others as well, if you had to pick a winner as a sector in February, it was technology locally. Other sector that performed really, really well was building materials. And in general terms, we had the season actually being saved by smaller cap companies and not so much by the large caps. The losers in February were the international cyclicals, the mining companies and the energy companies. The results were quite disappointing, and that translated into losing share prices as well. Share prices went down both for energy and mining, and they were at the bottom of performance over January and February. Another sector that simply never seems to get it right is telecommunication, with exception maybe of a few small caps there. And then the one sector that used to be an absolutely shoe-in for solid performances was healthcare. And again, February did not deliver for healthcare. Investors will have to be more patient, it would appear. Now, the irony here is that obviously what happens in February doesn't necessarily give us a guidance for what lies ahead. For example, healthcare is seen as one of the best performing companies in terms of profit growth for the years that lay ahead. So past not always a perfect guidance for what lies ahead. In general terms, there are a few things I've put out here. These are the statistics of the season. We had below average beats and we had above average misses. That sort of summarizes it, and that goes for the whole season. If we go to the large caps, you see that the statistics look a lot worse, and the ASX 200 sits in between the two. So the season has been saved by the smaller cap stocks. For forecasts, is on an average EPS retreat of 5.5%. Negative thus, but needless to say, in a polarized market as is the ASX, the outlook is very much diverse between sectors. I mean, on the positive side, you will find insurance and healthcare, for example, and technology. On the negative side, you will find the commodities and the banks, for example, and the combination of all of that above is a minus 5.5. Positive feeling goes towards the next year, fiscal 25, but growth there is only 4% on average for the market as a whole. If you know that the long-term average is about 5.5% positive, then we're still growing. We're still expected to grow at a below average trend this year and next year. And that sort of gives you the feeling why there's not, let's say there's cautious optimism in the market, but there's not necessarily feelings about a new raging bull market has started, apart from the fact, of course, that the market is very, 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 very much polarized. Now, that's the short-term status of the share market. And short-term is just that, of course. And I want to take you a little bit to a broader picture now, because as investors, as I said earlier, we should always have an eye on the long term, and because investing is a marathon. And what happened in February is, again, even though the share market it was good enough for Australia, and some of the stocks, of course, they rallied hard, and the market as a whole had a mildly positive experience in January and February. We were up by the end of February, since the beginning of the year, about 2%, which is, I mean, we take it. But in the US, of course, they were up 15, if not more. And that is not something that only happened so far this year. If you look at the longer term picture here, which I'm showing, then it's clear to be seen that the orange line is the S&P 500. I haven't even compared to the Nasdaq. And the blue line is the ASX 200 in Australia. And what we see is that, of course, we had a period in the 90s where the gap really opened up between US stocks and Australia. And at the time, it was everyone's idea that was obviously caused by technology, internet and internet infrastructure. And Australia didn't have that much of it, supposedly. But that all converged again in the subsequent years. So it didn't last. Ultimately, we moved into an outperformance, a strong outperformance of the Australian share market in comparison. And then we went into the GFC. That all came to an end. We sort of kept pace in the first 2 years or so, and then it starts opening up, and it really has opened up since 2015. And two observations to make here. The gap between the US share market and the Australian share market has probably never been this wide. And the outperformance of the US market in comparison to the Australian share market has never been this long, like it's going on now for 16 years. And that raises a lot of questions. And one of the popular approaches in finance is the reversion to the mean. So if this were to revert to the mean, then Australia has a lot of catching up to do. And that could translate into many, many years of outperformance locally, and also to like big chunks of outperformance that we have to, in order to catch up, at least on a relative basis. We can also obviously, there's many ways in which this can happen. It can also mean that the US tanks and we don't, and all the scenarios in between. But if we take a long view, like 100 years and longer, then the performance of Australia and the US actually is quite similar. You would be surprised by this, but it is quite similar. Both are in the top 3 of best performing share markets throughout history. And that makes this outperformance of the US, of course, that's more remarkable. And is it feasible that we are going to see a reversion to the mean, which means now that the pendulum should swing to Australia at some point? It's an interesting proposition, of course, because I know of fund managers that are positioned for that reversion to the mean, and they will tell you, in interviews and in their videos they publish that we are going to catch up to the US at some point. So what I find interesting here is to find out whether there actually is a fundamental reason why the US is now outperforming so strongly and for so long. Because if there is a fundamental reason, and if that fundamental reason remains in place, then we would have to conclude, all else being equal, that there will be no reversion to the mean. And also in finance, of course, there are many, many items that we can point out that there will not be a reversion to the mean for the simple reason that the fundamentals have changed. And that's one of the things I like to investigate today with you guys. And before we do that, I want to take us out of finance just for a few seconds. And so we go to the art world now. And what I'm showing you now here is, according to insurance companies, is the most valuable piece of art in the world, in history. And if we let inflation do its work, then soon it will be worth $1 billion. Though I'm pretty certain that some of you will now be thinking, like, there must be a catch here, because what's really up to? I mean, this doesn't look that special. And the reason why that is I think it's the same principle as applies in finance, is that you have to take a little bit of distance. You have to take a little bit of distance from the artwork to really, really appreciate what it's all about and to see the true beauty of it. And the reason why I make that comparison is I think we should do the same thing in finance. And when we take a little bit of distance from the finance markets, we take a little bit of a long-term view, then you'd be surprised sometimes what pops up in your vision. Things that otherwise we wouldn't be aware of and we wouldn't be paying attention to. Because if we keep on watching day-to-day share price moves, there's a lot that just escapes our attention. And I'm telling you that because I know of the difference myself. And clearly, there are many, many, many ways of investing and trying to make money from the share markets. And for many people, it also includes hopping on and off of stocks, buying and selling, and trying to pick the troughs and the peaks. But for many, many, many investors, and including large ones and smaller ones, there is a tendency to take the calm and moderate approach and to basically buy and hold for longer periods. And on that scenario, of course, a stock like I'm showing here, that would be ideal. Because yes, we see obviously volatility, we see sell-offs, we see rallies and all of that. But ultimately, you start at the bottom on the left-hand side of the chart, and you end up on the right-hand side on the top over time. And that's a scenario that, as a long-term investor, that's what we want to see. Now, this is Microsoft, and if you look at that chart, we could feasibly assume that this is probably one of the reasons why the US is outperforming Australia. Yeah, look at that chart. I mean, and that becomes increasing even more so if we compare it to, for example, one of the major index constituents in Australia. This is National Australia Bank. Now, I always think that if you show these charts to a 5-year-old, they immediately see what's on the chart. And the first one, I'm assuming, that child would say it goes up. And if you show this one, I think we all agree that doesn't go up. I mean, there's a lot of movement on the chart, but there's an element to be said that if I just go back, and this is 16 years, by the way, there's an argument to be made that I actually, throughout all the movement, all the volatility, the angst, the joy and the angst again, that I actually haven't made any progress. And by just looking at those two charts, we could possibly already have explanation as why the outperformance of the US is so stark compared to Australia. And then also consider that Australia is not amongst the bad performers in the world. It's actually amongst the good performers. So there is, maybe we have something here that we should investigate a little bit further. Now, some people might say Microsoft is a technology company and NAB is a bank. And that's your explanation. And you can also refer to the 90s, and we are basically doing the technology race again. That's one approach. But let's take an argument then and look and stay within the finance sector in Australia with the banks. And I've gone all the way back to the bottom of the GFC, and that was the 6th of March in 2009. I remember it quite well. And what I've done is I've taken the worst performing bank in Australia. Well, not because the regionals like Bank of Queensland actually performed worse. I've taken the worst performer from the majors because they also have a very, very strong influence on the index. Now, if I go to the bottom of March 2009 and I go to March this year, which is only less than 3 weeks ago, then if you owned Westpac shares and just kept them, I mean, you made 4.7% ex dividends average a year. So you add the dividends and you come between 9 and 10% without franking. And I'm assuming for many investors, they would say like, well, that's not too bad. I mean, now, take into account that we are measuring off the bottom of the GFC. If I would raise the bar, then that's 4.7% would disappear quite quickly. And in many scenarios, we would only have had the income from the dividends. Now, if we now look and compare with Commonwealth Bank, then the outcome is enormous. The gap between the two. Commonwealth Bank shares have over the same period and from the same starting point and the same end point have done more than 22% on average over those 16 years ex dividends. And so they're both banks, and the difference is quite enormous. And it gets even depending on your angle, it gets even worse or better. If I stay within the financials and I go to somewhat also of a bank, Macquarie, then my average return over that period is 68% per year, and you can add the dividends on top of that. So I guess what I'm leading into here is that it's not about technology versus the rest, because none of these are technology companies. Yes, they use technology. There's an argument to be made that Commonwealth Bank, amongst the banks in Australia, has invested most in technology compared to the rest of the sector. And that would actually still undermine the fact that Macquarie has, by definition, is the most advanced in technology amongst Australian banks. That's a given. That's not an opinion, by the way. But also, can I point out that Westpac is the cheapest of the big four, and that in comparison is that Commonwealth Bank is the most expensive of the big four. And the intriguing element here is that Commonwealth Bank is not the most expensive right now. Well, they are, but they also were the most expensive at the starting point in 2009. And they also were the most expensive throughout the period. It's not like they became the most expensive at the end of that period. They were pretty much the most expensive and payers of the lowest yield in the sector. And you can make an argument that Macquarie is even more expensively priced than Commonwealth Bank. And its dividend yield is closer to CBA than it is to Westpac. So just a few preliminary observations. The cheapest stock has the worst return. The most expensive stock have both better returns than the cheaper one. The lower dividend payers have the better returns than the higher dividend payers. Those are just a few observations that maybe can lead us to what we are looking for. Here I put the whole thing into graphics. These are the 4 banks, and I think we all agree CBA looks a bit pretty much like that Microsoft chart, and the other 3, they just don't. I mean, that's the direction is absolutely completely different, and I haven't manipulated anything to those charts. I've simply taken 16 years for all of them. So there is a sharp difference here, and we are still looking for the fact of what could potentially explain this. And clearly, needless to point out, it's not the cheapness or to be expensive or less expensive, which has made up the difference. Now, this we obviously mourn the passing away of Charlie Munger this year. And as a nice homage to Charlie Munger, Warren Buffett wrote about Charlie and his times recently in his letter of Berkshire Hathaway. And what I found interesting is that this quote here, where Warren Buffett actually says that what Charlie taught him and what changed his investment horizon is that Charlie essentially said to him, stop buying cheap companies. Buy great companies at a reasonable price. And that's essentially, I'm paraphrasing it here, but that's essentially what Charlie Munger said to Warren Buffett to do. And if I just reflect back on the past 16 years for the banks, then there's an argument to be made that both Macquarie and Commonwealth Bank are better businesses than is Westpac. Now, in my personal research, I always try to emphasize what makes a good company or a great company and what makes a not so good or not so great company. And I'm usually not that interested in the lower quality companies, but it's also very contentious, like what makes a great company and what makes a not so good company, because everyone has his own interpretations of that. So which models the way that you can actually measure these outcomes. But maybe this is one of the items that can help us in establishing what makes a great company and what are the others. Now, this is research done in the US and here in Australia by BetaShares. And essentially what it does is they have done research into trying to figure out why some companies have a price chart like CBA, Macquarie, and Microsoft, and why the other ones don't, and over a long period of time. And what the research suggests is there's a strong correlation to companies investing and companies who don't invest or just very little. And what we see here, let's just forget about the billions. Let's go to the percentages, which I think is more telling, because the market caps in the US are a lot larger than they are in Australia. Now, the average of the Nasdaq companies, and also realize that while everyone always thinks about the Nasdaq as technology, there are lots of other companies in there, like an Apple and an Amazon, who officially are not categorized as technology companies. And there's also biotechs and other sorts of companies in this. So it's not just the Metas and the Googles and the Microsofts who are in there. But on average, those companies, and also given the size of those companies, they spend double digits on research and development each year as a percentage of their sales, which is absolutely massive. If you know how large some of those companies are, like Meta, for example, or an Alphabet or Microsoft. The comparison with the S&P 500 already shows you that there's a big gap. It doesn't look like much, but that's 40% difference. But that's not the real comparison that we should be making here, because we have quite a lot of companies in common in both indices. So if we take out the companies that are both in the Nasdaq and in the S&P 500, this is the real comparison that we're making. So essentially, it is 10 times as much. 10 times as much. Hence, this research suggests that a great company is a company that is able to consistently spend a lot of money on developing new products, on reinforcing their moat, on strengthening their market share, on finding new growth and new products and services, and overall making the company a better company. And that could well be the difference between investing in Westpac, regardless of how cheap they become, or sticking with CBA, regardless how expensive they become or how cheap they at one stage become. There's always a big joke to be made in finance. This time is different. The most difficult words, and usually it is used when there are bubbles and share markets at their highs. But I've been arguing now for quite a number of years that this time is different. And this on the macro level, there are quite a lot of differences. We are unmistakably moving into a slow growth world and have been for quite a while. There's not much efficiency also to be had, and also probably the major change that we are going through is that we are going through it almost an unprecedented time of technological advances and technological innovations and changes. Now, what that means, I believe, and I've written a few books about this, and I've done quite a number of presentations about this, and my research, of course, is ongoing. But what I believe these dynamics, what they do is they polarize the market, because not every company is adept enough to catch up with the new requirements in a slow-going, technologically driven environment. And other companies are better suited. And so that difference, I think, is what we also see in the share market. The share market has been, in particular, on my observation, post 2015, maybe a little bit earlier, 2012, become increasingly more polarized between the haves and the have-nots. And in February, if I can go back to the short term, in February, what we saw is AI as a word, as a term being used already, and increasingly come to the fore, increasingly being mentioned by companies, and not just in the US, but also in Australia. And AI has that potential to polarize economies and companies a lot more than already has been the case. Now, that's not necessarily going to happen immediately. These processes, they usually happen over quite extended times. But to give just one extra comparison, my favorite reference period is the 1920s. And share market, particularly in the United States, had an incredible time from after the First World War until 1930, when everything came crashing down. And of course, as an investor, it's our choice whether we focus on what happened in the 1930s or what happened in the 1920s, and it was both very, very different. Now, I'm not saying that we will copy carbon, repeat that exercise. But what I do believe is that the replication of the 1920s is that some companies are going to have a jolly good time, and they're going to be generating very high returns for shareholders. And there's going to be lots of others that won't do it. And that, of course, taking a longer term view, I think is something that as investors, we should keep in mind. One of the buzzwords that is increasingly coming up in finance, and I'm one of the people who definitely pays attention to this, is the concept of megatrends. And megatrends are trends that remain in place for a very long time. And if companies are being driven by it, it also means they have the wind in the sails for a very long time. And as investors, you have to question whether you should then focus on the valuation, which might look expensive in the short term. but which won't be a deterrent to ongoing strong returns over a long period of time. Now, the other element that is changing in these times is that we have now different business models and we have different characteristics, and there are companies out there that grow incredibly strongly. Those revenues seem very secure and those margins are incredibly high. There are still people in today's share market who think they can simply put a backward-looking PE ratio on companies, on all companies universally in the share market, and decide which one's a good buy and which one isn't. I say good luck with that, but you are so 19th century. Today we should have a different view on the share market and on how to value companies. I'm not going to spend lots of time on that particular item today, but I'm going to say two things. Firstly, stop using backward-looking PE ratios. You're not doing yourself any favor. The second thing, of course, is start accepting that how to value a company has become increasingly more sophisticated than it was in the 1950s, 1970s, last century. And obviously, for someone who runs a business which pays attention to all those valuations and price targets being put on individual stocks, I see that change and that sophistication happening gradually and over time. One of the people that you could pay attention to if you're interested is Aswat Damodaran, if you haven't heard from him already. He is, in our time, considered the dean of valuing companies. He's a professor at the University of New York. You can fly to New York, pay a lot of money, and follow his courses. You can also do the cheaper alternatives. He has videos on the internet. He has courses that are available, and he writes books that can be bought for like $20, $30 or so. And you can spend a lot of time on figuring out all the variations in valuing all the types and sectors of companies, and just make sure that you don't drown yourself, because there's a lot to it these days and a lot of mathematics. Now, having said so, because we can't stick with the theory all the time, but I've been doing this research for quite a while. My research has focused on what makes some companies so much better than others, and I've come up with this concept of all-weather performers, about which I write on a regular basis. Years ago already, in 2020, this I took from the presentation in those days. I tried to illustrate to people what it means, why the share market will be polarizing, why it has been polarizing, is because you get, strictly taken, if you put things in black and white, you get two baskets of stocks. You get stocks that are old economy and they're just suffering from all the changes, and they can't really adapt, or it takes them a long time, and it is a very gradual process. And then you have the other ones who are basically driven by it. Now, the first category of stocks, what I'd like you to imagine is that you're riding a bicycle, push bike, and you're going uphill. And that's basically what those companies are doing. And yes, the share price goes up, and they still manage to stay profitable and to keep shareholders happy for a while, sort of. But basically, the way is uphill, and at some point the levee breaks, and as a result, share price tanks. And if you're there, you have a lot of losses that you have to chew on. Low quality, old economy, not investing in the business. The share market is full of them. And if I just want to share a few recent examples, Lend-Lease, Helios, AMP, Iris, there's no coincidence that ultimately those companies they get cheaper and cheaper. Not necessarily in the share price, but definitely in relative valuation, but often also in the share price. And then ultimately, they get so much in trouble that new management has to come in. They have to restructure. They have to sell assets. They have to close down assets, and sometimes it ends with basically someone else buying them. If you follow these companies over time, And it gets obfuscated because there's a class of investors out there who will buy anything that gets cheap enough. And that's fair enough. That's a different investment strategy. That's not mine. I like to have companies for many, many years in my portfolio. But what it at the very least shows that you have to be careful with buying cheaply. Because cheaply for the wrong reasons can cost you dearly, and it doesn't necessarily lead to better investment returns, as we've also seen with those examples I mentioned earlier. Now, the other company is the one that is still riding the push bike, but it's going downhill and wind in the sails. So you can sort of imagine what an easier task those businesses have. They effectively, what I try to illustrate here, they have to be careful that they don't fly too high, essentially, that it doesn't go too quickly, too soon for them. But that's a much easier way to create shareholder value, as I think we will all agree. Now, coming back to my research started during and after the GFC, because I got really interested in figuring out why some companies go in so much better way through those tough times and through those heavy downturns, while all the other ones drop like flies. And I think that research has done me quite a number of favors over the years. And if I, in recent times, following on from my CBA and my Microsoft observations, if I look at some of them that have been on my radar in my portfolio, I own them as well. I talk about it, I read about it on a regular basis. If I open up the price charts for some of my favorites, I can only see that, even though some people might say, but Rudi, you're biased, but I'm not putting it in the open. Those charts look very much familiar to the Microsofts and the CBAs, which I showed you, I think. I mean, the first favorite, of course, is Technology One. Yes, technology stock, but very much old technology. If you really want to put it in a basket, I mean, Technology One was there when the Nasdaq deflated in 2000, so it's been around for quite a while. And once that Nasdaq disaster was put behind it, it has been absolutely fantastic performer for everyone who bought, let's say, in 2004 and just held on to them. Another one of my personal favorite, which is equally held by me and has equally been on my radar for a long time, is REA Group. Again, was around in the early 2000s. It was around in the GFC. But if you held on to them, the market positioning, this is now essentially regarded by many as the highest quality stock listed on the stock exchange. Now, I have to say, it used to be a race between CSL and REA. Now CSL is sort of out of focus because it hasn't performed for a while. That's just how the finance sector works, of course. From the moment CSL start performing again, you probably will get again the discussion whether it's CSL or REA. At the moment, it's REA, and again, that chart looks very similar to my eyes as Microsoft I just showed you. Of course, the one observation to make here is because there's now a trend for Australian investors to put more money in the US market because the US performs better. But maybe an observation to make here is that you can have US type returns in Australia as long as you have Microsoft type companies in your portfolio. And then I don't necessarily just refer to the technology part of Microsoft, but just to how the chart looks. Another one of my favorites. I've been talking about this one for quite a number of years, and you can also see that this, by anyone's account, is not technology, but Goodman Group, of course, is one of the better performers in the share market. Has been now for quite a while. They used to be just an ordinary property developer. They went almost bankrupt in the GFC. And it didn't take much. It was a very close call. But they learned a lot from that. They completely built a better business out of that experience. And if you take that period out, then you see that that's just a Microsoft type chart. Goodman Group is usually my example that I use in investing in megatrends. Goodman Group is because it builds the properties for the likes of Amazon. It rides the megatrend of e-commerce, and it now is also riding the megatrend of data centers, AI. And those two megatrends, in particular now the arrival of the data centers, is enormous for a company like Goodman Group and for the shareholders and for the share price. It doesn't mean that those companies can't do anything wrong. It just means they have so much wind in the sails that it becomes so much easier. And one of my favorites, NextDC. I mean, I was buying somewhere here, so you can see why I wake up every morning with a big smile on my face. NextDC, of course, data centers, megatrend. The extra observation I'd like to make here is that many people have been calling Goodman Group overly expensive for many years now. The reason is that they look at Goodman Group and they see a property developer. Now I think you look at Goodman Group and you see megatrends. There's a difference there, and there's probably you have to change your views and to get to the core of what actually moves companies. The same thing with NextDC. For some reason that I don't understand, the ASX has added NextDC to their technology index. And so everyone looks at this as a technology company and says it's not profitable and blah, blah. It's not technology. I mean, NextDC is essentially an infrastructure company, just like the NBN is, just like Transurban is, an APA group. It's just that at this point in time, they're in a much earlier phase of their development. And of course, they are carried by enormous demand where they are ideally positioned. Their problem is attracting enough funds to finance the building of more and more data centers. Now, I mentioned it a little bit before, and it did come out of February as one of the new buzzwords, and I can guarantee you, we are going to hear and read a lot about artificial intelligence in the years ahead. It's part of the reason why there's a new hype, a new bubble, maybe early bubble forming in the US. That's how we humans operate. But I need to say also, the fact that a share price like Nvidia has gone up by hundreds of percentages in a very brief time span does not by default mean that that's a bubble. I mean, people severely underestimate how strong growth put in those valuation models for modern day companies like Nvidia, how much that can boost the valuation of those companies. And the example that we have locally is Goodman Group, which I earlier pointed out. Practical example, Goodman Group, before they came out with their results in February, was trading around $24. The discussion that went around is that was that expensive or was that fair value? From the moment Goodman Group releases their results and explains to the analysts what is happening and what are the prospects according to management, those price targets to a very large extent moved into the 30s, and the share price now is also around $30. So you can see coming from $24 to $30, that is a lot of gains. And it is not because there's a bubble happening. That's the impact of growth on the valuation. And that's why I was referring earlier that if you use backward-looking PEs, you will never gonna get that, and you can never invest in those companies. Now, AI will be a long-term story, just like the internet has become a long-term story, and AI has the potential to be much more powerful than the internet, but it won't be a straight line, and it won't be happening tomorrow. Nevertheless, what AI potentially will do is, for some companies, help them increasing in making more sales and decrease costs. Now that might mean stronger growth on lower margins, which also means higher valuations. But it will also increase competition. it's not a free win for all. And I believe, as I expressed earlier, I think over time, it's going to divide the share market into haves and have-nots. Now, we have here a few sectors that are, at this point in time, seen as potential beneficiaries, and there are a lot of them that might, but it's not that clear cut that the other ones are not necessarily going to benefit. I had the pleasure of bumping into a recent research study update by Morgan Stanley. These guys spend a lot of time on these things, and they obviously have a lot of input from America. And they had identified these 5 sectors as likely, most likely seeing the benefits over the next few years from increasing investments in AI. Now, that doesn't mean because, for example, media and entertainment is in there and financial services in there. It doesn't mean, of course, that AI is the only element that will determine the outlook for those sectors, but it can potentially become quite powerful and pronounced. Now, and just as we thought, of course, that we had found the new Holy Grail, there's plenty of value investors that will tell us that if you look from a longer perspective, technology in the US has seldom, if ever, been as expensive on a relative basis as it has been today. And this, of course, is the reason why the bubble fear is popping up here and there and in the media and amongst investors, etc. Probably the best thing to put against this is, and this is only from a week ago, by the way. This is one of the experts on Wall Street that actually believes that, irrespective of the chart I just showed you, that those large technology companies are actually still cheap. And that, I think, is what makes it the market. It's never straightforward, and it's always easier in hindsight. Now, I think what I've tried to paint to you today is that there is a lot of stuff that we focus on in the short term, but there's a lot of stuff that happens and that we can only see when we take a more of a longer term perspective. And I guess investing is longer term. And while in the short term, markets are on all-time highs and they may or may not at some stage have a pullback. All those price charts I showed you, there were pullbacks in there, many of them over many years. But ultimately, that particular type of company that managed to get the share price to new all-time highs, and that, I think, is probably the key message that we have from today's presentation. There's a pronounced difference in the type of companies that are listed, and it's majority versus minority, and I'm happy to stick with the minority myself, I must say. A few more things. I do run a portfolio, and I do understand that you might not necessarily be interested, but underneath that portfolio is my research in all-weather performance. And that research, of course, aligns with the long-term views I just expressed to you. There is the secret report, which I can only recommend that you download it and read it. And then we have come to the end of my presentation. I hope you liked it, and I am open for Q&A.